I'm Tom Selzer from Livewire Markets, and joining me today is Gary Monaghan from Fidelity to discuss all things Asia. Gary, thanks for joining us.
Thank you.
Gary, we're going to start at the top. What's your headline outlook for Asian markets right now?
I'll answer that in two ways. So if you're taking the long-term opportunity and outlook, it's pretty bright. And when I talk long-term, I'm talking 15, 20 years' time. So if you look at the markets today in Asia, Asia's about 40% of the world's population. It's about 25% of GDP. It's half the world's growth today. And by 2040, it's estimated it will be about 40% of GDP. So a big growth opportunity from a macroeconomic perspective. But we invest in markets, and Asia equity markets today is only 9% of global markets. So even if there's a little bit of catch up, there's a really, really strong tailwind to the long-term opportunity across the board. But also we do invest with a sort of 1, 2, maybe 3 year time horizon, and because your investments wax and wane and chop and change as you go along. And as we're sat here today, we're more constructive on China than we were 12 months ago. Yes, it's got its challenges. Okay, yes, the macroeconomic situation is not booming, but almost the worst is behind. A lot of sort of issues around the property market and the consumer have happened, and we're just sort of grinding, begrudgingly grinding upwards. And if you have less worse and cheap valuations, it often drives a re-rating. So we're relatively more constructive on China. India, we were very concerned 12 months ago on valuations. Great long-term story, but it was way more expensive than even the US. But now in recent quarters, the share prices in India have started to derate a bit. Earnings expectations are coming down, which is good because it becomes a more normal level. And so increasingly finding a few sporadic opportunities in India. And then you've got the tech-heavy career in Taiwan, which everyone knows about AI and the structural opportunities there. These companies are front and center of it. And there are certainly long-term opportunities there. But again, never forget, tech is cyclical, whether it's AI or not. So there will be opportunities to top up or to trim. But yet it is front and center of this whole AI revolution that we're seeing.
You've given a pretty good overview there, but maybe for investors that haven't considered the region previously, what do you think the draw is at the moment?
Well, it is that first point I was talking about, is the growth. The GDP growth, and GDP doesn't always translate to markets, so I have to be clear, but it's better to have it on your side than not. And so you can see with markets like the ASEAN markets, I'm sure in Australia people know Indonesia very well, you've got those sorts of markets that are definitely growing with good demographics. You've got India and China too. I think for investors who have not really given it a serious look, you look at it for not just the growth, but the diversification as well. It does have its tech plays, but it's not as tech heavy, for example, as the US. It does have its resources plays, but it's not as resource heavy as Australia. And it gives you a real opportunity for the areas like consumption and for emerging trends that are coming through the region.
You touched on China there. I think you've recently called for anti-involution, not revolution in China. What do you mean by that, and what does that look like in practice?
So I, like millions of other people, had to look at what involution actually meant when it was being talked about back in June, July time. So what involution is effectively entanglement. And what came around in July is President Xi himself actually started to say, and in his speeches, that they needed to address this involution chaos. What that means in sort of a Chinese market perspective is that they need to push whether it's regulators, authorities and companies, there needs to be a greater push to stop that overexpansion that Chinese companies can sometimes be sort of guilty of, and to stop undercutting each other. And I'll give you a great example with electric vehicles. Electric vehicles in China, they're very good, but they're just building them in a massive volume, and they're competing on price. So you've got a great volume opportunity, but margins are being compressed because everyone's battling for, and undercutting each other. So this sort of anti-involution is around companies and authorities and policymakers getting together to really sort of make a more rational, competitive environment. And in some cases, maybe predominantly around areas like steel and cement, is just to continue with production cuts where they need to be made. So don't just keep pumping out stuff. because that's what you've always done. Just make sure you're a bit more strategic in your thinking, and maybe you do the production cuts where they need to, so you don't end up with an oversupply and a massive dip in pricing.
And just move into AI for a second. It's obviously the narrative that is hard to escape at the moment, but what role is it playing in your portfolios and overall outlook?
Yeah, so if you think about AI, we think of it broadly in two terms. You've got AI enablers, so where you've got Asian companies like TSMC and Samsung, SK Hynix. That's SK Hynix we don't own, but we do own the other two, that are component producers that go into whether it's AI servers and such to enable the AI evolution that we're seeing. Then you've got the AI adopters, and that's companies that are actually able to use AI and in a way that can actually create new revenue streams and new avenues for monetization. One of the challenges that AI poses, I would say from an investment perspective, is that everyone will tell you they're using AI, and everyone is the best they can, but mostly it's to improve efficiency. So it's to make a report a bit quicker, it's to scrape data. But very few companies have been able to actually demonstrate how to monetize the AI adoption. And so you're looking through the companies and understanding. And look, some of the Chinese companies in the internet space, like a Tencent as an example, are big enough, they're smart enough, they've got the big enough ecosystem and data platforms that they need to use AI to better connect its customers to advertisers. And actually it creates a better monetization opportunity. But not everyone can do that. And so for us in an AI space, it's the enablers, but stick with the ones that are the market leader and are here to stay, like a TSMC, and the adopters. But they will have a price. So you have to be aware of that. And so therefore, we're conscious of the valuation of these areas, but still see the opportunity there.
And just moving to your fund, I think it's been 20 years since the launch of the Fidelity Asia Fund. But do you mind just talking us through, I suppose, how the strategy's evolved over that time, maybe where the opportunity set has changed, and also what the tailwinds are going forward?
So in terms of the broad opportunity, it's always been about capturing that Asia growth story. But of course, that changes country to country. And the Chinese growth story from 15, 20 years ago around build out of infrastructure and so on is not the growth story of the next 15 years. So it changes, but it's still a growing sort of part of the world and growing part of the markets. That's not changed. But in the portfolio, over the last 20 years, we've just become much more concentrated. So typically you should expect the portfolio now to be 20 to 30 stocks. 15 years ago, it would have been 40 to 60. So it's getting a bit more concentrated in that way, capturing the real sort of alpha generating opportunities. And then from a market perspective, it's just, quite frankly, just got bigger. Like the Chinese mainland onshore market, the A-share market, did not really exist to investors until 10 years ago. India as an investment destination was considered a real sort of frontier market 15 years ago. Now it's front and center of a lot of people's minds when they're thinking emerging markets. So the opportunity set has got bigger as the economies and markets have evolved.
And Fidelity have a big ground presence in Asia, but how do you use that to your advantage to find hidden gems, especially, I suppose, as your portfolio has got more concentrated?
Yeah, so we've got offices dotted all around the big cities around the region, and it's about getting boots on the ground, local knowledge, and then feeding it into a sort of a global network. So you do see what could be optically on the ground good companies and a good opportunity, but you take a step back and there might actually be better companies elsewhere in the world. And maybe you may have seen that business model before in another country, somewhere else globally, and you realize it always sounds good, but it never works, right? So it's about using the team on the ground to feed in the opportunity set and highlight the ideas. And of course, as well, because they're on the ground, they can also give you a local flavour that you just wouldn't get if you were sat in an office in Sydney all day long. It's about providing that on-the-ground presence, and this is what's happening day to day. The numbers and the anecdotes don't always match up. And so it's good you see the numbers, but you get the anecdotes from the team as well, and it can really help clarify the thesis and to connect the dots.
And finally, Gary, I think you've been involved in the Asia strategy for 13 years or so. What are some of the most memorable stories and experiences from that time?
Oh, there's a few things we could pick out for sure. I think if I think about the sort of 2014, June 2014, this is when we made a change to the portfolio to make it deliberately more concentrated. We had investors that would just said 20 stocks in Asia will never work, and you need to have 80, you need to have 100, and that's something that's always stuck in that. There was a lot of doubt that you could make a concentrated portfolio in emerging markets and relatively volatile markets work, and I think the last 12 years or so has proven that we've been somewhat successful in being able to do that. Another memorable one, actually more recently, would be the launch of the ETF that we've done. We've got the standard mutual fund, but you've had an ETF wrapper, which a lot of people, not me, but a lot of people put a lot of work in order to operationally get up and running, and it's a really interesting change, and it really gives you a sense of how customers are changing the way that they're buying products as well. So, and we have to change our mentality, the way that we think about the funds, potentially with ETF buyers versus a standard mutual fund buyer, absolute versus relative returns and so on. And then more specifically to the fund would be a stock, Quayshaw Multi, which it was in the fund since 2014, and we bought it around 120 renminbi per share. And we exited the stock only a couple of months ago. So it's been an ever-present, different position sizes. At some points it was 10% of the fund, other times it was closer to 2. And when we finally exited, it was about 1,600, right? So it was a multi-bagger, and it was higher than that at previous points in over the last decade as well. But why it's so memorable is that you've uncovered a stock that, really the sentiment towards it was massively negative back then. President Xi came into power back in 2012, was talking about anti-corruption, and the general market view was no one's going to be drinking Baijiu again. Right? It's an expensive sort of 50% liquor. No one would be drinking it again, anti-corruption, nobody's going to be gifting it between companies, and the share price just tanked completely. And it was one where we took a step back and said, there's heritage to this brand. Within China, it's a staple brand. Like it's got extreme heritage going back decades and decades of history. And as the corporates was maybe stop gifting it to each other, it will get to a price point, because the price was coming down, to where consumers who've been desperate to get their hands on it could suddenly start to get their hands on it. And with that, we saw the business model change from a sort of a business to business to a business to consumer. And you ride the wave with that. You understand the business model, that the way that someone like Multi operates. They sell at the factory gate to wholesalers. They don't sell at the shops, and people can get caught up in the price at the shop. And that's not what Multi makes. So you're constantly looking and finding opportunities to really make money in a big multi-bagger, 10, 12 times what we paid back in 2014.
Gary, thanks for joining us.
Thank you.
Thanks for tuning in. Make sure to check out our YouTube channel for more great videos.